Hit it.
It's Saturday, January 2nd, 2021, episode 112. Happy New Year, everyone. I'm Patrick Ceresna.
And I'm Kevin Muir. We're pleased to have Market Wizards author Jack Schwager back on the show for our second part of the Market Huddle holiday special. But before we do that, Lena, hop on.
Hello. Happy New Year.
Happy New Year.
Yeah, we still do not have any beers.
We're still hungover from New Year's.
Anyway, it's looking forward to a good start to the year. So let's just jump right into it and continue our conversation with Jack Schwager. So we are pleased to welcome back Jack Schwager to the second part of our holiday special. And this time we wanted to talk a little bit more about some of the stories from the past Market Wizard books. And so, Jack, first of all, welcome back to the show. And you've obviously had the opportunity to interview some of the greatest trading legends out there. And after so many of these interviews, which of the Market Wizards has made the longest lasting impression on you?
Well, I guess if I said who would have the biggest impact on me personally, which interview would probably be Bruce Kovner, because of one line, in that interview that I eventually adopted and was very important. And I think it's probably maybe the most important advice you can give to any trader. And Bruce Kovner said, basically, I know where I'm going to get out before I get in. And that, to me, if I was restricted to one sentence of advice, that was the proviso, that would be the one sentence I would choose. And the reason that's so critical is a couple of reasons. First of all, it is so important, because think of what it does. If you decide where you're going to get out before you get in, either by putting in a stop or by just you have enough discipline to stick with that decision, then you've automatically defined what your approximate worst case loss is on that trade. You're not going to have your account get crushed by one bad decision. You decide, well, I'm going to risk 1% or 2% or 0.5%, whatever it is on this trade. And if you're wrong, that's what you're going to lose. So that one sentence will get you literally 90% plus of the way to risk management. I mean, it's incredible. There've been entire books written on risk management, but that one sentence will get you almost all the way there. So that's one reason why it's so super critical. The second reason is emotions are detrimental to trading, generally speaking. This has come up again and again and again in every Market Wizard book and in multiple interviews. We as humans, as Bill Eckhart, who I interviewed in, I think, New Market Wizard, said, humans have evolved to seek comfort, and we will make worse than random decisions in the markets. So our instincts and our emotions will lead us astray. And he's saying worse than random. That means he'll do worse than the proverbial monkey throwing darts at the proverbial monkey throwing darts at the Wall Street page. So it's not that the monkey will do as well as professional money managers, which is the point of that story. It's that but Eckhart's saying the monkey will do better. So getting emotions out of trading is kind of a really important thing. Because it's going to lead you astray. So think of things that people do out of emotion, in impulsive trades, deciding that, I can't get out here, I've lost too much, I'll give it more room. All of these types of things or I just lost so much money on the S&P, I'm going to get it back from the S&P, and then you try and make more trades and dig the hole even deeper. So by having this rule of know where you get out before you get in, it removes that emotional context, because you've made the decision at the onset. And think about it. What is the one thing you have before you put on a trade that the instant you put on the trade, you lose? You want to take a shot at it?
No, I don't know. What is it?
Objectivity. So So before you put on the trade, you can think rationally. Where should the market not go if I'm right, and so forth. Once you put on the trade, it's gone. You're no longer objective. You want that trade. You'll find all sorts of excuses why what you're seeing in the markets, whether it's in its action or in news or anything else, you'll find all sorts of reasons why either it's not really bad for your trade or why it's supportive to your trade. You're going to be very biased, but before you put on a trade, you could be objective, and that's why those are all the reasons why this one line of advice from Kovner was so important.
So Kevin here, Jack, too many people seem to focus on the getting into the trade, and you just mentioned Kovner focusing on getting out of the trade. Do you think that is the prevailing thing that makes most traders great? When you've seen all these terrific traders, do you think that is the most important quality?
Probably, because that really comes under the umbrella of how should I put this? Risk management, essentially. I mean, it's really if you're and then, by the way, where you're going to get out, we're not worried so much about where you're going to get out if you're profitable. I mean, this is more a matter of where you're going to get out if you're wrong. And so that really does fall under the umbrella of risk management. And yes, virtually all traders I've ever interviewed consider that kind of essential in some cases, or in many cases, more important than their own methodology. So that concern, as I forget who originally said it, but I don't worry. The line is paraphrasing. I don't worry about what I might make. I worry about what I could lose, that type of thing. That type of thinking is all part of the same thing. And so, yes, having a plan on where you're going to get out if you're wrong is critical. Now, where you're going to get out if you're right, certainly, traders have that as well, but not everybody. Some will let the trade develop and decide as it goes along. So that's less critical unless it's part of the methodology. For some traders, deciding where to get out, if they're correct, is also like a trader like Barge, for example, will have a point where we'll get out probably many times of most of the position before the end of the day, but although may hold a component for longer term. Essentially, the target is an important part.
Sorry, I keep walking all over you there, Jack. It's Kev. So am I not mistaken that in one of your books, one of the traders said, I think if you applied disciplined stop losses, you could pick positions at random and make money in the market?
Yeah, I don't remember who would have.
Yeah, you're like me. They all blend together. It's good to know it's not just me.
I don't know if it's a particular line because that's kind of a philosophy, that is shared by many traders. Although I will say a good example in unknown market wizards would be Peter Brandt, who is actually the only trader maybe in there who's not totally known because several years back he started doing a blog, Twitter,
That's right. He's big on Twitter, and there's a lot of people that follow.
He has a trader following. He's still not, part. He doesn't manage money, and the general investment world doesn't know him. But
Right.
but he's But anyway, Peter uses charts. I mean, he's an old chartist going back. I mean, his written chart book, the book he learned from was Schwager, which predates the famous Edwards and McGee book, and so. He's been a student of charts his entire life, and he's always used charts to trade. But he admits that the charts don't really predict anything. All that it does is it helps him define which points is there a reasonable shot that the market is going to move near term in a given direction, and the "and" is very important, and also allows him to place a trade with a small amount of risk. So when he gets that combination, that's what he puts on the trade. And his line in the name of the chapter, but it kind of summarizes his philosophy is strong opinions weakly held. So when he puts on a position, he has a strong opinion, but he said the minute the market puts his hand in my pocket, I'll be out. And so he might be bullish a market, one day, and then he'll be out the next day. He doesn't have any commitment to to that. And it's not that the charts are predictive. It's just that they give them a tool of when to place a trade with a limited amount of risk.
So, Jack, I figure that, you've interviewed some huge legends in the business. And I suspect when people meet you, they must ask what it's like to talk to this person or that person. But sometimes it might feel like you're like Led Zeppelin, always getting asked to play Stairway to Heaven. And
I don't like it.
And so one of the things I would be curious about, what are the underrated gems, the ones that you feel, the interviews or the traders of all your books, of all your series, that you feel like, I actually was surprised. This guy I found to be really great and really terrific, and it's not something that a lot of people talk about. Are there any that stick out, like just ones that you love that you feel don't get the attention they should?
Yeah, I don't. Basically, I go in, already expecting. If I'm interviewing them, by definition, I have, sort of high expectations, and so I don't get surprised because I picked them for the reason why I consider them exceptional. So, it's that surprise element is not there for me. As far as and as far as the response goes, that's very difficult too, because when people say to me, about any of my books, they'll say something like, "Hey, which chapter I really like best?" And I have no idea, because it's always some different chapter. Because different chapters resonate with different people. So you'll have some people say, "This is my favorite chapter," and you'll have some people say, "Well, the only chapter in the book I didn't like was the same chapter." So it's so personal. So I don't know that there's anybody that or how people react, because they react. There is no common answer there.
Right.
So,
Well, I found that even as my career in the markets has progressed, my appreciation of different interviews has changed. And it's funny you mentioned Kovner, because I've gone back, and although I liked that interview, I didn't think it was quite as mind-blowing as some others. And actually, when I go back and read them, he's one of my top picks. Like, I love that. So let's talk a little bit about, how do you go about doing these interviews? Like, when you read them, it doesn't seem to be that long, but then I read that when you were explaining the process, a lot of these interviews occurred throughout a whole day. You would go, you get there in the morning, you'd chat, you'd talk, and then you would actually go out for dinner. How does it work? Walk us through when you do one of these interviews.
Actually, I've done interviews that span 2 days, like Ed Thorpe, which was the longest chapter I ever wrote for Market Wizard's book. So people might have the impression that I kind of turn on the tape recorder and this is the conversation. Believe me, well, first of all, that's not doable, because if I did that, to start with, there'd be chapters that would be between 300 and 400 pages long by themselves. Secondly, it would be deadly dull. And third, something people don't, unless you've done this, unless you've actually done interviews and transcribed them, you don't appreciate how totally
how I think I know where you're going. You're saying that the spoken word doesn't actually write down as well. I've had a few things.
We speak and we go all different tangents. We don't finish sentences. Where it's just a mess. If you transcribe any conversation, if you try to read it, it looks like a complete mess. And so and I know is that what I wanted to do. So what I do is I do the whole interview, and I will go. And there's some, like in this book, that literally 10 hours, 12 hours of tape. And it's not just like listening for 10, 12 hours. You have to go back and forth, back and forth. I mean, I could spend weeks going back and forth on one interview. But my first step is I extract anything that is either says something that's important for traders, or is interesting. It has to have some reason to be there. So I just extract the raw parts that are at all either interesting or insightful and meaningful, and then you have to make it readable. And so you have to take these sentences that are grammatically a mess and put them into a readable form. So if I get the exact wording, if if I can use the exact wording, I'll always use it. But the exact wording is ungrammatical or the sentence doesn't finish, but I know what the trader is going to say, then I'll finish it. So I'm trying to stay true to what the trader said, if possible, but if what they intended to say, if not. And the end product is probably much closer to conveying what they're really saying than a verbatim script would be, which would be unreadable anyway. So that's and then once I got that, this reorganization, because you may talk about the same topic in hour 2, in hour 7, in hour 9. And so I try to pull that all together and I try to make it into some coherent flow. So bottom line, I'm trying to get something that is, that reads well, it flows, and yet stays absolutely true to what the trader is saying. And, when I always send the final draft to the trader to see if I got anything wrong or if anything's misrepresented. And usually it's, and in most cases, I think they believe that's exactly what they said because it is what they intended. It either is or it's what they intended to say. So it always works out pretty well. The main thing, though, is it makes the book readable. If I didn't do that, then they would just be, dull.
So you've gotten some legends. There must be some that got away that you regret never being able to interview. I can think of one very famous guy that was generally considered the grandfather of all great hedge funds. Are there any others that I can think of?
Yeah. So who you're thinking of? I'm
Soros. Like I'm assuming that that's probably the one that you.
That's what I would have said. So of all the traders I didn't get, Soros is the one I most regret. I just couldn't get him. I never spoke to Soros, by the way, directly. And when I did interview Stanley Druckenmiller, who did work, within Soros's group. In fact, Druckenmiller ran Soros's funds for, 7, 8 years or whatever it was, while Soros at that time, after the Berlin Wall came down, was spending all his time in Eastern Europe and Russia, just trying to get those countries in line with a more free market capitalistic structure, which is ironic because he gets criticized for being an extreme liberal. Where actually he was trying to get these economies to be capitalist. But so that's what he was doing, and Druckenmiller was doing all the trading for the Quantum Fund and other funds, and Soros would occasionally call in and stuff. Now Druckenmiller had a close relationship, obviously, with Soros, and I asked him if he could get Soros, but it just didn't work. And I tried several other times where I never got through to Soros. I spoke to some intermediary, and I don't even know if Soros got the message. So he's my biggest regret because he is certainly, if not the best trader of modern times, would have to be in anybody's list of top 10.
And were there any others that are kind of?
Yeah, another obvious one which I tried several times was Jim Simons of Renaissance, and one time he turned me down, and the second time I was doing another book, he thought about it for a couple of weeks and then turned me down.
Okay, so I'm going to put you on the spot, Jack, and if you don't want to do it, I completely understand. Sure. Give me your top 3. If you had to manage money and allocate money, who would you do?
If I had to allocate money, there are a few traders in this book that I would be as comfortable with giving money to as anybody I've ever interviewed.
Really?
Yes.
So why do you tell us? Like, who would you?
Amrit, so I mean, and I don't mean to exclude anybody else, but by saying this, but Amrit, Sal, we talked about Richard Barge. One trader we didn't talk about is Jeffrey Newman, who may well be the best trader I've ever interviewed.
So why is that? Why? What makes him the best trader you've ever interviewed?
Truly extraordinary. He's maybe one of a kind. He first of all, he started out with he had a $7,500 stock account. $5,000 was a stock position his father had left him, and $2,500 was money he had scraped together, and that was his trading capital. That's what he started with. I interviewed him in mid 2019. He had made $50 million from that original $2,500. I've been in contact since then. He's more than tripled that in the last year and a half.
And what?
So at this point, he's $150 million plus on a $2,500 investment. I mean,
how does he do it? What makes him truly that outstanding?
So when I kind of went to sleep after I interviewed, and he was one of these guys I interviewed all day, most of the day, and then again into the next day. But next night after I'd interviewed him, I went to sleep and I was thinking about it. And it's sort of in my sleep, sometimes you think of these things and it comes up, and you kind of know it when you wake up. And I had one word for him, and the word was early. And I think that was let me check. I think that was early period was probably the first the first word of the conclusion of the chapter. Let me just double check if I'm right.
While you're doing that, Jack, I'll tell you that happens to me all the time. I do an interview and then I go to bed and I think, oh, damn, I should have asked that.
Yeah, so I'll read it. So early, it came to me in my sleep one night. I was working on Newman's chapter. I hadn't realized that I was interviewing Newman, nor in the initial days of listening to my interview recordings and working on the chapter. A common theme that underlies Newman's spectacular successful trading career and a recurrent source of his edge is that he is early. So what I mean by that, he picks up on trends right at the beginning. And it doesn't mean that, and I'll give you an example in a moment. It doesn't mean that trend or those companies will be long-term successful. It just means he captures an early trend. So, for example, 3D printing, when it first came out. So he's the type of guy, 3D printers come out, he orders a 3D printer from every company in the business. He talks to the CEOs. He's looking on social media. He's talking to people. He's getting a sense. And so when he thinks something's going to be a trend, he gets in, and he may get into these stocks when they're trading like at $1, or sometimes they're small companies or or even sometimes, sub-dollar. And you know how Peter Lynch, famous for the 10 bagger. I mean, I can't tell you how many trades Newman has had that are probably a 100 bagger, literally making just 100 times his money on some of these investments. But he gets in very, very early, and he then will stay with trade and stay with it. He only trades alongside. And as something let's say 3D printers stop showing up on financial news shows talking about these 3D printing stocks, and it's people are investing in it, and there's all this hype about how they've gone up so much, and that's at the point where he starts basically looking to get out. And when it starts breaking down from sort of a distribution top, he's out. And I take 3D printing as a great example, because those companies may have gone from 1 to 100, some of them, and they went all the way back to where they began. So it's not that he was predicting long-term 3D printing is going to be the future, but he predicts it right at the beginning, when it's the beginning of a big trend. Mm-hmm. And so he's done that time and time and time again. And he will get out right away. He tries to get the breakout from what he believes the beginning of a trend, where he's expecting one to form. He'll get out right away if he's wrong, and so he may take several shots at it before he finally gets it. Then he rides it, and he adds along the way when there's points where he can add with well-defined risk, and then he gets out when it becomes too popular. And he's done that over and over and over again. And so he trades these major themes, and he's very early in and very early out, and he has an uncanny knack for picking these things.
In the previous interview that we did, you mentioned that you thought that when you wrote Market Wizards 1, or the first one, the original, that it was a unique time in the markets, that they would do that great, and that there was a few things that lined up that made it such that we would have these truly outstanding returns. And since then, a lot of those people that you've interviewed have gone on to make these multi-billion-dollar hedge funds. Do you think that their ability to, let's just say, continue to outperform has been, well, we know that it's been hampered by the size of their fund, but do you think that if we gave them back to the original point, like we said, okay, here's $1 million, that they would still be able to do it in this environment? Like, do you look back and think that those guys were truly...
So yeah, I think you're talking about people like Bruce Kovner or Paul Tudor Jones.
Yeah.
And, right. So they're, going on to, Kovner with his firm Caxton, and Jones with, Tudor Corporation, so Investment Corp. So, and they went on, like, managed build tens of billions probably. And sure, when you're managing that type of portfolio, you can't make. When I interviewed Kovner, he had his past 10 years, he had averaged 88%. You can't make 88% a year managing billions, Um, so yeah, if you put them back to a small size, uh, I'm sure they could have done much better than they did with the. Nothing wrong. I mean, they built large funds because they were doing well. I don't know what his average return was over the many years of the fund, but certainly it was not 88%. And I'm sure, and also if the amount of money would go back to a much smaller amount, yeah, I believe that they could make higher returns again, and there is definitely an inverse relationship between the size of the money being managed and performance. So ironically, small traders do have a big edge in that they're small.
Right.
You don't realize that, but they do.
So let's take the first two books. I'll give you the first two books, and you're gonna the person that you get to pick is gonna be back down to trading $1 million of your money, and they are incented to do well because they are no longer billionaires. Who do you give that money to?
Oh, I have to think who's in each of the first two books. I don't have them in front of me. You know,
Or give a couple, just so
yeah. So I mean, Druckenmiller, who's in the second book, would be a good choice. He was consistent for a long time, and actually, with trading a sizable amount of money. I mean, I think
So he's my favorite. That's who I would pick. Like it would be without a doubt.
Miller is the epitome of the professional manager or great managers, sort of a 30-year career, averaging pretty close to 30%, compounded. So he's kind of got an extraordinary consistency record. Somebody like Jones or Kovner, I'm sure, are still, are exceptional.
Yeah. So let's go back to Stanley for a little second there, because he's always struck me as being kind of a head above even all the other greats. And maybe I'm wrong. Maybe I just like the way he trades. But I found not only did he have an understanding of risk management and dealing with those sorts of things, but his ability to kind of go against a trend and do things that were really odd and yet do them in size. Like I remember seeing him interviewed the other day, and maybe it was a year or two ago, and he was long like 2 tech stocks, and they were like Facebook and Amazon. He had picked like the 2 best performing tech stocks, and I was just like, how does he do it? Did you find, were you struck by the same sort of surprise at how well he was able to match both just the understanding the big picture things that you need to do to actually manage money, but then also kind of almost be a great stock picker and a great currency trader and all these great things as well?
Yeah, well, that was his modus operandi. He was both a individual, because he started out as an individual stock picker and had his own fund that he ran for his whole lifetime. Even when he was with Soros, he still was managing his own individual fund, which began at this early part of his career. And so, being an individual stock picker was almost a starting point. And then, as he matured a bit, he started getting into global macro, particularly when he worked for Soros, but even before then, surely before then, but most prominently, those years and thereafter. So he's somebody who's both paying attention to the individual stocks and on the big trends. And the other thing that's part of his way he trades, invests, whatever, is and something that he gives credit to Soros. He said that Soros taught him how to be a pig. In other words, when you're very, very confident, you really want to step on accelerator. So it's totally within his normal type of approach that he should be putting a lot of money into just a couple of positions, because apparently he had whatever analysis he did, he was extremely bullish on those stocks. And so the way he trades is to step on the accelerator when he's very bullish or bearish. I mean, so depending on the market. So those are really characteristics, and he has great skill on both sides, and yeah. So
I'm a huge fan. I'm a little bit like that. That would be if I could go and spend lunch to pick one person's brain, it would be without a doubt I would choose Stanley Druckenmiller. So, Jack, I don't know how much of a drinker you are. We here at the Market Huddle, we're Canadian, so we end up drinking a lot of beer. I'm going to ask you this next question: if you had to go drinking with anybody that you're out of your books, who would be the most fun? Like, who would you choose to go out drinking with?
Oh, God. Oh,
were any of them just crazy? Like they just seemed like, oh my goodness, this guy, the kind that you're just like, you're saying like they're dragging you from bar to bar and you're like, I got to go home. This is crazy.
Yeah. So I kind of, my mind gravitates to the people, not on a cerebral level, not on a crazy, level otherwise. And so,
you don't have anyone like that. There were,
nobody that pops up as being sort of wild and crazy.
So who were the ones you mentioned? Some are easier to interview than others. The ones that weren't easy to interview, was it just a function of them being not comfortable talking about it, or what, you don't have to give names, but what would make the difference between some?
I'll give you a couple examples. I mean, so from, I believe it was Newmarket Wizards, Gary Bielfeld, and kind of an interesting story. So this is back in the days where I was a research director, and you look for, you have to write commentaries on markets and stuff like that. Look what's going on. Well, you'd speak to the floors and get information from them. And as far as bonds go, there's always this name. BLH was a buyer of was a buyer of 10,000 bonds or whatever. And I kept on hearing, you'd hear Solomon, you'd hear Morgan Stanley, these big firms, and BLH. And I'm thinking, who the hell is BLH? Well, I found that BLH was this one guy, Gary Bielfeld, who was I'm trying to remember the time. He was in, I think, in Iowa, some smallish town.
Peoria, Illinois.
Peoria, Illinois, right? Yeah. So some small town, right? And one man show. And then I dug in deeper, and when I interviewed, turned out that he had started trading. He didn't have much money. He started trading literally 1 or 2 corn contracts because that's what he could afford. And by the time I was interviewing him, he was literally trading 5,000 T-bonds, 10,000 T-bonds. Just mind-boggling, right?
Right.
So this is a story, a guy on his own in a small Midwest town, growing like that. And so now that sounds like a fascinating story, I thought. And the story is fascinating. But when I interviewed him, I couldn't shake the image of Gary Cooper out of my mind. In the old days, yep. I mean, God, but the story was just so phenomenal. But I had to get it in somehow. And it's a short chapter. It's the one chapter where my narrative is longer than the interview. Just to tell you something.
I guess when you're getting yup back, that's all you get. Yup.
Yeah. Well, at one point he said, he came up the analogy of poker and trading. And he said, please turn it off. So I turned off the recorder, and he gives me this, this interesting analogy, about, between poker and trading. And then after he finished that, well, why do you have me turn it off? It's the only interesting he said. It was literally the only interesting he said. And I said, well, why'd you have me turn it off? And he said, well, I just didn't want to have the image of it being associated with gambling or whatever. So that's an example. Then he allowed me to use that that thing. So that's an example of a very, very difficult interview. And the only reason I included it was, like I said, the story was just amazing. Now, in this latest book on Market Wizards, I have a different type of difficult chapter, a fellow by the name of John Netto. And Netto, just for background, graduated high school with, I think, something under a C average. Didn't even think of going to college. And ultimately, though, found, joined the Marines, completely changed his whole mental attitude. Eventually developed his own methodology, kind of sophisticated trading methodology, where he uses computers to analyze what's market reactions and stuff to the announcements, et cetera, et cetera. I mean, I don't want to go into too much detail, but that's kind of pretty complicated stuff, even though he academically never had anything. So it was an interesting, and he had some interesting stories and things to say. But I think the analogy I used is talking to Neto was like speaking to a New Yorker who's late for his train.
Yeah, you know what? We actually have interviewed John, so I know what you mean.
Oh, okay. So
not only do we interview him,
and then he's one of these guys who goes off the 50 tangent, and he kept on sprinkling sentences like, "Yeah, that probably won't come off too well," or "That's not going to sound right," and that's a bit of a spaghetti bowl, isn't it? So he was cognizant. He was cognizant that what he was sprouting forth was like a mess. So
he's enthusiastic. Enthusiastic is a good word.
Only his enthusiasm causes a degree of incoherence, and not being critical. It's just kind of just to describe it. But yet he has important things in there and good stories and everything else, and he's done very well. So I came very close many times. This is impossible. I can't make this. It's like, it would have been easy to quit, right? Yeah. And I came close, but I just said, no, there's still stuff in here. And I sort of redid draft after draft after draft after draft. And finally got it. I said, okay, yeah, that's kind of good. And he was very happy with it. And but that was another example of a very difficult interview. So and what people don't realize is that, people sometimes say, hey, you're a really great interviewer. No, I'm a mediocre interviewer, but I'm a great editor. That was a perfect example of that.
Okay, speaking of your book, let's actually go to the end here. You have these conclusions. I would love to just kind of rattle off a few and get your reaction to them. Let's start with the first one. You say there is no single true path.
Yeah. So this is addressed particularly to novices, people coming to markets, and they think, gee, there's something out there that if I get that, boy, it's an easy way to make a lot of money, whether it's somebody selling a system or some guru giving advice or it's some technical approach to the markets or it's some way of some using fund. They think there's some sort of secret thing to the markets and you get that and it's a money machine. And the thing is, nothing could be further from the truth because you could read all 5 of my wizard books and you'll see just about everybody is different than everybody else. In terms of methodology, they're all doing different things, and the only similarity is they find an approach that works for them. So the whole idea of trying to find this absolute secret formula or one path to success is wrong, and if people try to tie it to one person that they're using as a model, it's probably not going to work because that approach has only a very small probability of being right for them, even if it works for the particular trader. So I think it's really important for people to understand that, hey, this is not a matter of finding some secret method or formula. It's a matter of finding a method that works for you.
Okay. So one of the next ones is keep a trading journal. And this is from your latest book. And I was wondering, do you think that this is a function of the new era of traders? Like, do you find that 20 years ago, people were as keen to keep trading journals?
Yeah. I mean, you'll find it in other market wizard books, the same advice.
Okay.
And it's the reason why it's important is primarily, not exclusively, primarily because so you can learn what you've done right, and more importantly, what you've done wrong. And if let's say you had a trade and you made some sort of mistake. Okay, if you journal, you write that in a journal. You said, okay, I did this in a trade. I knew I shouldn't have done it. It worked out terrible. Don't do this again. Well, every time you make a mistake, and by mistake again, let me emphasize, I don't mean a losing trade. I mean when you did something that deviated from what you know to be correct market behavior, trading behavior, or deviated from your risk rules or whatever, or deviated from your methodology. That's the mistake. So not whether you lost money. And so if every time you make a mistake, you write it down, and periodically you review that journal, as a number of traders in this book indicated they do, then it will, at best, of course, hopefully it eliminates that mistake. But if nothing else, it'll reduce the number of times you make the same mistake. And getting rid of mistakes in your trading is the best way you can improve as a trader. So keeping a log of all your trades that are of any consequence. I know you can also learn from things you did right, but it's more important to learn from your mistakes. That is a critical lesson that comes up with many traders, probably most prominently with Ray Dalio, who's the founder of the world's biggest hedge fund, Bridgewater. And his whole firm is built on a philosophy of learning from your mistakes, incorporating that knowledge, and making the methodology better.
That's terrific. That's a great piece of color from Ray. The next one is the power of asymmetric strategies. I know this is a lot of buzzwords that we hear from all the gurus in finance, but it's something that you conclude in your book is one of the most important things.
One of the things that defines great traders is that they, for the most part, their wins are going to be much, much, much larger than their losses. So for most people, if you put their trading, wins and losses on a probability distribution, it'll look like a normal curve, more or less. And for really great traders, what you see is you get this really large tail on the win side, these extreme wins, but you don't have it on the losing side. And this idea of trying to find points in time where if you're right, you'll make a relative large amount of money relative to what you will lose if you're wrong. That goes to the heart of many of the approaches of traders that even if they use different methodologies, in their own way, they're trying to pick these points where their gains can be much, much larger than their losses.
So the next two are going to kind of appear to be in opposition, but at the same time, maybe not. So the first one is take larger positions on high conviction trades.
Right. So, Druckenmiller will attribute, for example, we talked about Druckenmiller, so let's use him again as an example. Druckenmiller will attribute his success to the fact that when he was ahead like 40% for the year, he wouldn't just like most managers would like play real cautious and sort of nurse that gain to the end of the year, so they had a really good year. And in a way, from a business sense, maybe that makes sense in the business perspective. But Druckenmiller would look at it just the opposite. He would say, whoa, I got a 40% cushion. And here's a trade that looks like it can go to the moon. I'm going to really load up on it. So he had that sense of when there's an opportunity that is a high confidence, large potential opportunity, just really, really go at it. He cites one of his experiences when he worked for Soros. So at one point when he had joined Soros early on, he got very bullish. This was actually, I think, might have been before the Berlin Wall came down, or after it came down. And he goes to Soros and he says, he goes and gives him all the reasons why he's bullish on a D-mark. And Soros says, okay, yeah, so how big is your position? And Druckenmiller says, well, I have $1 billion on this. And Soros says dismissively, $1 billion? You call that a position? So his point being, like, if you're that bullish, why aren't you bigger? So, and that's part of his approach, and that's what it means by taking large positions when you're highly confident. Of course, you still have to have the risk management side to it.
Right. So let's go to the next one here. I don't mean to interrupt, Jack, but it's don't trade so large the fear becomes a dominant factor.
Great. And they do sound contradictory, and they're not. So the first one we talked about. Now, there's the thing where, I forget which trader it was, but like the example was early in his career, he had this position, and then he decided then he had a stop point, and then he doubled the position. A little bit out of greed, trading larger than he was comfortable, trading. And then the market had a small reaction, and he got stopped out of both, everything. If he hadn't done anything, he would have had a great trade. The trade went on to be a big winner, would have been a big winner. But because he had doubled the size and became so fearful that he had to get out on a smaller reaction, he got out where normally he wouldn't. So the idea is, if you're in a position, one way to tell, if you wake up worrying about a position, you're too large. So it goes back to what we were talking about before, emotions. Emotions are detrimental to trading. So if you have a position where you're fearful, that means you're you're risking too much. And your emotions are going to get the best of you. So the idea is, while you want to trade much larger on high confidence positions, the limitation is you shouldn't be so large that if you're wrong, it would be too big of a hit. And while you're in it, you're fearful.
So, Jack, if there was one thing that I would sum up as what I've learned from Jack Schwager, it's this following: distinguish between trade outcomes and trade decisions.
Right. Yep. And we talked about that a little before. People think that there's two types of trades outcomes. That you're winning trades and losing trades. And one of the points I try to make is that is erroneous thinking. There are really four types of trade categories. There are winning trades and losing trades, but there are good trades and bad trades. And the important thing for people to understand is that good trades can be losers, and bad trades can be winners. For example, if you're sitting in front of your screen and you're bored and you want to make a trade, but you don't have your methodology isn't giving you anything, and you say, "Oh well, I'll take a shot at gold." You buy gold, and it goes up, and you take a profit. Well, that was a winning trade. It wasn't a good trade, because if you did it over and over, taking trades without any justification, you'd probably end up losing. Plus, it's distracting you from trying to pay attention to the trades that make your money. It's sort of like the example talked by Richard Barge, where he had a trade where he had a large loss, froze, then the market came back and he got out a small loss, but it was still a bad trade. It was a good outcome, but it was a bad trade. So people distinguish.
So this next one I love, and I see too many people, especially the gurus in FinTwit on Twitter, that get a hold of something that makes them like a call that they get wedded to, and they can never change. And I love what you say: the flexibility to change your opinion is an attribute, not a flaw.
Yeah, and that's why people. Talk about Peter Brandt. Peter Brandt, will get people who criticize him on Twitter, and they say, "Oh, why you listen to Peter Brandt? He recommended going short the S&P 1,000 points lower." Well, yeah, he may have said he went short the S&P 1,000 points lower, but the end of that sentence, he got out the next day at a small loss because he realized it was wrong. So that's a critical distinction.
I think it's something that people get attached to, thinking, "Oh, I can't go back on this. This is what I believe in," and they end up being that's their whole personality.
Yeah, personally speaking, this is a good example. So when I was research director, I found that was a very big impediment, because I would write about a market and make some prediction, and that would mess up my trading, because I said, "Well, I was bullish. Now how can I go short?"
Yeah.
So that desire not to change, contradict yourself, is a major impediment.
So this is another one of your comments that kind of goes hand in hand with this. It's being profitable versus being right.
Being what?
Profitable versus being right. Too many people want to be right instead of profitable.
Right, and that sentence really says it all. Really, it's people are too tied to wanting to be right. So many mistakes come out of people wanting to be right, and it's the job of a trader is not about being right. And the flexibility thing is so critical. And I think what could predict if a trader is being successful or not. Traders who are very rigorous, in their views, or loyal to their views, as I would sometimes say, are going to fail. And those who are very flexible. Well, let me give you the perfect example. Again, we'll go to Druckenmiller. Druckenmiller, 1987, Friday 16th, 1987. And that, for the people who have trouble with the date, that is a Friday before the giant crash on Monday in the stock market in 87. Anyway, that Friday, people sort of forget, but it's not that the market suddenly crashed. The market actually had a big decline, and the week before the October crash had a very big down move. So Druckenmiller's sitting there. He's been short in multiple funds and figures it's come down to a support level. So what does he do on the Friday before the giant crash? He covers all his short positions, but he doesn't stop there. He goes long, and he doesn't stop there. He goes leverage long. So what a catastrophic mistake to go from short to leverage long on that Friday. Now, if you go back and look at his record, he actually didn't lose too much in that October. And the explanation is that he realized over the weekend that he had made a mistake for multiple reasons, and it's not important why, but he just realizes that. So he had every intention to get out of his positions on Monday. Trouble for Druckenmiller, Monday morning, the markets are opening up like about 12% lower, gap, just a giant gap down with this massive selling. But what does Druckenmiller do? Instantaneously, right at the first opportunity, he gets out all these short position, long positions he put on Friday. He gets out of them all at 12 to 15% lower, whatever the amount he got filled out immediately. And what else does he do? He goes back short again.
Wow.
So that is flexibility. That is the epitome of flexibility, and that's the ideal. People who are dogmatic, I would say, are not going to be good traders. You have to be able to admit when you're wrong. In fact, I have a line from this book which offended some people, and I actually, while I had my political views, I said politics aside, but I said politics aside, if Trump was a traitor, he'd definitely lose because he's never admitted he was wrong. And so, because I thought he was a perfect example of a person who just cannot admit he's ever wrong. And I think if that's who you are not going to be a successful trader.
That's awesome. That's a great line. I never thought about it that way. So we're almost done here. I'm going to get last two for you. The first one is I'd like you to describe the two sides of patience.
Yeah. So the two sides of patience. So the first side of it is, and this is really important. You have to wait for the right trades. Like Warren Buffett, I think, said it, and it's not like baseball. We have three strikes. Three strikes. You can just keep on waiting until you have the right pitch, and that's really important because you only want to trade when you have the right opportunity. That's the first side. And there's also a quote that I'd like that relates to this is by Claude Debussy, classical composer, who said, "Music is a space between notes." Now, what does that have to do between trading and music? Is that, well, trading is a space between trades. And I can think of one great example, a trader by the name of Kevin Daly that I interviewed in Hedge Fund Market Wizards. But when I interviewed him, he had started his fund, which he was mostly a long-only trader, in late 99, right before the top of the market. And after 12 years, the market had been absolutely flat. The S&P was sideways. He had a cumulative return of over 800%. Well, partly because he's a good stock picker, but most importantly, because during the bear markets, he didn't trade much at all. And he had that patience just to wait. And the first bear market was 2000, 2002. He had the patience just not to trade much. And that's why by sidestepping those 250% declines, he was able to make a lot of money. But you need the patience to wait, sometimes enormous patience. And the other side of patience is when you're in a trade that's working, don't be tempted to jump out too early if things are all working right. Too many people will grab the first no profit because it feels good and then forego 90% of the move. Now, if your methodology is just to get the first swing, that's okay. But if your methodology is to capture market moves, it's not okay.
Right. And then we'll just leave it on this one, which I think is a great motto for us all. Successful traders love what they do.
Yeah. True of anything. I mean, in any profession, any sport, sports or music or writing or whatever, people who excel, they love what they do, and traders are no different. The language traders use are game-like analogies. Kovner talks about trading, the metaphor he uses, three-dimensional chess game. One trader talked about back in the days when we had charts, chart books, he taps his chart book and says, somewhere in here, there's a treasure, and my job is to find it. Those are game-like analogies, and it tells you that this is a game. This is something they enjoy. They probably would, it's a game they would play even if they weren't getting paid. So love of endeavor is critical.
Well, Jack, I just want to take a moment to thank you again for not only being so generous with your time today, but for writing these books that were oh so important to me as a young kid growing up and then as my career continued. And thank you for this last book that I enjoyed tremendously. Why don't you tell people the name of it, where they can find it?
Sure. Unknown Market Wizards, and basically you can find it at any bookseller, Amazon, Barnes & Noble, et cetera, et cetera, et cetera. So again, Unknown Market Wizards.
Well, terrific. Well, thank you again, Jack.
Hey,
thanks,
thank
Jack.
you very much.
What a great way to start the new year by just getting a lot of that knowledge that Jack Schwager was able to share with us.
Yeah, Patrick, I thought you were going to say that was a great interview with Jack Schwager, and I was expecting to give you a hard time and say, what are you auditioning for your other job again? That was a great interview with Lacey Hunt. What do you think now? Okay, so folks, thanks for tuning into the Market Huddle. We appreciate you spending time with us. Please give us a follow at the Market Huddle. We're on Twitter every day. Give Lena a shout out. She gets tired of talking to Patrick and myself. You can listen to the Market Huddle on all the networks: Google Podcasts, Podbean, Spotify, Android Play, iTunes, and YouTube. A lot of people watch on YouTube to see all of our charts and visuals. And while you're there, please like and subscribe to get our latest content. We're also on YouTube, iTunes. You know the game. It would be great if you could give us a review. We'd really appreciate it. Patrick, where can they find you?
You can find me on Twitter at Patrick Ceresna, and you can also find me at bigpicturetrading.com. Kev, where can they find you?
I'm on Twitter at Kevin Muir, M-U-I-R, or check out my newsletter at themacrotourist.com. And listen, we can never have too many friends. Bear market, bull market. We're just happy to spend some time together on this crazy ride. So thanks for tuning in. Now stick around for the abbreviated after show.
Well, that was a short show. No. Abbreviated.
Do we have anything to say? Lena,
No.
You're on the hook. You know, you've set the bar really high with this.
Did you guys watch the movie?
No.
Which one? I did.
Did you like it? You guys haven't said anything. I kept asking, did you guys watch the movie?
Did you watch her
did.
movie, her great recommendation?
Yeah. Oh my God, the Young Offenders.
Yeah.
So
Yeah.
one of the
I
guys I'm sorry to interrupt, Patrick. I'm just going to tell a story because I want to know if you feel the same way, Patrick. One of the guys I work with, I trade with, he said that he tried it, and 5 minutes into it, he had to put on the subtitles because he couldn't understand their Irish accents.
Oh, yeah. I should have said that in the beginning. I usually watch everything with subtitles now.
So, Lena, this is another thing that's different between us Gen X's, and we are not baby boomers for all the millennials that'll call me a baby boomer. We are Gen X's. We don't give a shit. Between the Gen X and the millennials is that you guys love the subtitles on everything.
Yeah.
And
Yeah,
the next generation's even worse.
Yeah. No, my kids want the subtitles. Yeah, it's nuts.
It's
Like I find it so irritating. I can't.
It's insane. I don't understand it. It'll be like
I don't get it.
Tesla at this valuation. I'll never understand. So, Patrick, what did you think of the movie?
I actually at first, about 15, 20 minutes in, I was like, I don't think I'm going to give this the time. And I was ready to shut it off.
You were going to hit the eject button.
And I was going to hit the eject button, bad trade. And no, I stuck with it, and it actually did get better. I really do like the idea of the little kind of anti-heroes and losers and stuff like that. It ended up growing on me. I liked it. Do you want me to rate it like a beer?
Sure. Since we don't have a rating of beers to do, give us the rating of the movie.
So do you want to do like a Rotten Tomato rating?
Yeah,
what,
for
like
sure.
100, 100 is good, right?
100 is good. How many tomatoes?
I would give it 79 tomatoes.
Oh, that's good.
Is that a good rating? I don't know. I don't know what. I don't.
Lena
ever
told me
try-
that it was getting 100 tomatoes, so I was pretty excited about that.
for the one review.
Exactly.
That's funny.
Oh,
You
this is
gotta watch
old. I didn't even realize that this thing isn't new. No,
No,
so it was 100 tomatoes out of the critics. It was 84 tomatoes out of the audience. And as
That's
we know,
still pretty high.
it is high, but you don't listen to the critics.
No.
No. What's that movie you love? That terrible one from the 80s?
Which one? So
No,
many.
Patrick has one that he loved.
Like what? Like
Give me
Fight
your
Club or
favorite
something?
movies, Patrick.
Oh, here we go.
Oh my God, I was not ready for this. No, I like I don't know, like Fight Club. I like
No, come on. Don't try to be
Inception.
cool and edgy.
Yeah.
Give me your
I
real
like
one.
Austin Powers.
No. Like you had
What do you
some, like-
mean? Well, you're gonna tell me which movies are my favorite? I'm telling you my freaking favorite movies.
It'll be like
so-
Scent of a Woman or something.
No. Hoo-ah! No. Tell like there was some cheesy movie that you really loved.
Oh my God, I don't know.
I don't know.
Spaceballs.
Space.
Well, let's just take Spaceballs and let's look at that, and let's see how many tomatoes it got. Because there's a perfect example. 83 tomatoes from the audience. That's a good score. Well done. The critics, 56. They don't know what they're talking about.
Goddamn critics.
Yeah. So just be aware. Don't worry about the critic tomatoes. Only worry about the people
audience.
tomatoes. People know better.
All right.
Okay. Well,
Anyway, it's going to be a fun new year. I'm looking forward to 2021. Fuck 2020.
you know what? Let's just call it a day on that. That's a great way to end the show.
Great way to.
Take care, everyone.
All right.
See you
Take
next
care.
week.